Okay, so let's talk about how this exchange works. So I live in the United States, and if I were to travel to Canada, I would have to exchange my US dollars for Canadian dollars. So let's just say, hypothetically, I have 100 US dollars and I received 100 Canadian dollars. That means one Canadian dollar is equal to one US dollar. So I kind of hang out, have a great time in Canada, and I travel back, but I bring 100 Canadian dollars with me. But I receive 110 US dollars. What just happened? Well, what happened was the Canadian dollar increased in demand, or the US dollar increased in supply. And if the demand is higher than the supply, that means the demand becomes stronger, or the Canadian dollar gained strength against the US dollar, or the US dollar became weaker against the Canadian dollar. So instead of having to travel from one country to another country back and forth, and doing this, what we do as Forex traders is we utilize technology, charting software, to measure these different exchanges. And it's known as currency pairs. And you're going to hear that a lot. What currency pair are you trading? Now, there's a plethora of currency pairs to choose from, and so that example would have been the US dollar paired with the Canadian dollar, otherwise known as the USD traded against the Canadian dollar. You can do this with Great British pounds, Japanese yens, the euros, and so on and so forth. Okay, we can talk about a little bit more and a little bit of what currency pairs to focus in on in future lessons, but what we monitor specifically when we monitor these currency pairs is the price fluctuation, the supply and demand, the strength and weakness between the two, and we utilize the unit of measurement known as pips, PIP, or price interest point. So what the heck is that? Well, what you want to do is write down pip, PIP, circle it, because you want to capture or generate as many pips as you possibly can. So the easiest way to explain this is through a story. So imagine going to the bank with $1 US and asking the bank teller to provide you pennies in return. So a penny represents 1/100th of a US dollar. So you give the US dollar to the teller, and in return I receive 100 pennies. So imagine doing the same thing with pennies, but receiving pips in return. I provide 1 penny, but a pip represents 1/100th of a penny. So I receive 100 pips in return. So what we do is we're measuring strength and weakness between one country's currency versus another country's currency, otherwise known as a currency pair, and we monitor pips, price interest points, and it takes 100 pips worth of movement to equal 1 penny worth of movement, and it takes 100 pennies worth of movement to equal 1 US dollar. Now, what we do as Forex traders is we trade in what's called margin. And if you're in equities or in stocks, you're kind of very, very familiar, or even in options, you're very, very familiar what a margin account is. If you're not, explaining leverage may make a little bit more sense. So in the United States, we receive leverage. We receive 50 to 1 leverage. And what that just basically means is we have more buying power. So, for example, if I have 100 US and I want to invest into a currency pair or buy a currency pair, because of leverage, I can buy 5,000 US worth of that currency pair. Now, if I had $1,000, I would receive $50,000 worth of buying power. The reason why you want the leverage is very, very important to understand, because it increases the value of your pip. So instead of just receiving fractions of pennies worth of value, you can actually make a pretty decent income. So for example, because we trade on leverage, when you finally decide if you want to buy or sell a certain currency pair, what happens? You're going to be asked whether you want to invest 3 major lot sizes, one of 3. It's called a micro, a mini, or a standard lot. These are the measurements of different investment sizes. So a micro lot, it's a $20 investment on average. It just means that if you think the market's going to go up, you press the buy button with $20, and 1 pip represents 10 cents. So if you make 100 pips, well, you just made $10 off of a $20 investment. But if you lose 100 pips, well, you just lost $10 off of a $20 investment. When we talk about strategies and equity management, we're going to teach you how you can minimize risk and maximize reward. Okay, so a mini lot is when you invest $200 per trade on average, and 1 pip is equal to $1 US. So if you were to generate or capture, if you were to buy the market goes up 100 pips, and you're trading a mini lot, well, you just generated $100 US. And a standard position or standard lot is when you invest $2,000 on average, and 1 pip is worth $10. Now that means if you make 100 pips, you just generated $1,000 US. And it's relatively simple once you know what you're doing, and you can generate nice consistency to make right around 100 pips a day, or $1,000 US a day if you're trading a standard position and if you're applying the appropriate strategy that best works for you. Okay, so next we're going to be discussing buying and selling and the actual process of what takes place. As a Forex trader, you can decide to buy the market or sell the market. So if you decide to buy the market, it just means you're taking a bullish position or you're going long. And if you take a bullish position or going long, you want the market to go up. If you ever hear someone say, it really looks like a bullish market, it just means that the market appears to be going up or more people are buying. If you decide to sell the market, it's known as taking a short position or being bearish. If you ever hear someone say, it looks like a very bearish market, it just means the market appears to be going down or more people are entering and selling. Okay, so you can decide to buy first and then sell second, or you can decide to sell first and then buy second. Let's kind of break that down a little bit more and try to simplify this with a story. Let's just pretend you own a computer store. Well, what do? You go to the manufacturer and you buy your computers for $100, and then you sell your computers in your store for $200. So you buy low and then you sell high, or you buy first for $100 and then you sell second for $200, making a $100 profit. But you can also sell your computers first. How do you do that? Well, let's just say you go to a location, like a conference, and you bring a catalog or a magazine. You display your computers and somebody actually buys it. So you sell your computer first, and then later on you buy your computer from the manufacturer and then deliver it. So let's just say you sold your computer for $200 first, and then you went to the manufacturer and you bought your computer for $100, and then you delivered it. You sold high, and then you bought low, and you generated a $100 profit. Now, that's how you make money. Let's discuss how you lose money. So again, same thing with a computer analogy. You buy your computers first for $100, but nobody wants to buy them. And so what happens is you have to lower your price, and then you sell your computer for $50. You just took a $50 loss by buying first and selling second. Or if you go sell your computers, and you sell your computers for $200 first, you went to a conference, you sold them, and then by the time you got back to the manufacturer, they increased their price point, and you have to buy your computer for $250. So therefore, you lost $50 by selling first and buying seconds. We're going to be teaching you later on how to effectively buy low and sell high to minimize the risk and maximize the reward. If you're going to be a Forex trader, you got to get a broker. And the broker is going to be the entity that's going to place your trades on your behalf. Now, in the later lesson, we're going to be discussing and teaching you how to find a great broker. So when you decide to press the buy button or the sell button, there's a few things which you need to understand. You're going to have what's called the bid price and the ask price. The bid price is going to be the price point in which you receive when you press the sell button. The ask price is what you receive when you press the buy button. There will be a difference between 3 to 5 pips on average, and they can fluctuate up and down between the distance of the bid and the ask. The distance between the buy and sell price is known as the spread. Now, the spread is what your broker receives for facilitating your trade. Now, when you decide to enter into the market, you have two options. You can enter into the market with a market order, which allows you to physically enter in right away, or a pending order, which basically means instead of buying now, you say, I want the market to go to this price point, whether it's up or down, and then you physically enter into the market. So again, you can place a market order, which gets you in right away, or a pending order, which you say at this price point, I want to execute my trade. Now, after you enter into the market, you have what's called a stop and a limit. You don't have to use them, but it's important that you understand what they are. A stop is an automatic exit for a loss. You can predetermine how much you're willing to lose. For example, if you enter into the market buying and the market goes against you and you have a stop price, once your stop price is hit, you automatically close a position with a loss. A limit is an automatic exit for gain. So for example, if you're buying the market and then the market goes your way and it hits your limit price, you automatically exit the position with a profit. Now, what is a position? Well, a position basically shows your status of your current trading opportunity. So there's an active position. Active position means you are physically in the market. You have an active position. A closed position means your opportunity or investment is done. You entered into the market and you closed out, whether you hit your limit, whether you hit your stop, or whether you closed out yourself. So again, a position can be active or a position can be closed. In our next chapter, we're going to talk about charting software, specifically smarttrader.com, and how you can utilize that to maximize your returns. In this chapter, I'm going to show you how to connect your broker account and place a trade using smarttrader.com. So when it comes to trading your strategy, you're ready to go. The first thing we're going to do is go to smarttrader.com. Upon going to smarttrader.com,